Happy 2026, new year, new predictions. So a year ago, I made some predictions about what I thought would happen in the housing market. And this year, I have some pretty strong feelings of what I think we have in store for 2026. So let's take a look at how I did last year to validate if you should even listen to what I have to say about this year.
I think rates will stabilize. I think we'll see kind of low to mid sixes. We may dip into the fives. I think that all depends on overall economic outlook. That's how that market moves.
Rates. This one I actually landed as rates started to dip below 6.5% in September and October. And by the way, they were over 7% this time last year.
Prices will decelerate, not depreciate. So I'm gonna apologize in advance for all my doomsdayers and my housing crash buddies. The market moves on supply and demand, period.
Appreciation. According to the U.S. Fed Housing Agency, the U.S. housing market had a positive appreciation of 2.2% and has experienced positive appreciation since the market started recovering back in 2012. In fact, 44 of 50 states saw positive appreciation. But I'll take the small L here for slightly overestimating this range. But we did decelerate, not depreciate, as we were at 4% in 2024, and now we're seeing it much more in line with that 3 to 4% historical annual appreciation rate. Home sales. Almost nailed this one. I'll let you be the judge of this. We saw sales go from 4.06 million in 2024 to 4.24 in 2025, so a 4.5% increase. I'll let you judge me on whether that's close enough. Context, we usually see over 5 million a year since 2013, and we haven't been at a sales pace this slow since 2011. All right, so I'll let you be the judge on how I did there. 2026, here's what I think happens this year. We'll start again with rates. I don't think they're gonna move much lower than what we see right now, which is right around 6%. And I definitely don't think they're gonna go higher than 6.25. I think we're gonna see some stability here because of improved bond yield and rate spreads. And I could see high fives if that spread improves further. But it would require the economy to soften to a point that might make it uneasy, meaning higher unemployment, softer job growth, slower negative GDP growth, and other uncertainties that sometimes we're uncomfortable with. With all of that being possible, I just don't think we're gonna see enough to significantly impact rates. It's kind of a catch-22, right? Because lower rates means we're feeling less confident about other economic conditions. So cheering on lower rates means you're cheering on softer economic conditions. I do think because we've moved into some better buying conditions we've seen since before 2019, there's opportunity to negotiate closing help that could be applied to buying down the rate further. So there are opportunities to improve affordability past what the current rate shows. Existing home sales. I say they pick up modestly, and if you hold me to a number, I'll go ahead and say 7%. They'll move up 7%. This is on the back of what I believe shadow demand, so people waiting anxiously to get into the market, getting into the market, increased stability with rates in the low sixes, and some of the lock-in effect being unlocked. Lock-in effect is homeowners who have stayed put because of their historically low rate finally getting into the marketplace. It's estimated that 69% of mortgages are 5% or less. Home appreciation, everybody's favorite piece of this, right? What's my house worth? I think we actually stop decelerating. We see some stability. I say this because I think we'll see an uptick in home sales and rates are finding their footing. So I think we'll see home appreciation at about 3%, which seems modest given what we've seen the last few years. But historically, generally when house pricing improves, when we see rates move towards 6%, which is right now where we are. So I'm banking on previous market behavior. Okay, so here's some things to keep an eye on that could impact all of this, positively or negatively. So the replacement for the current Fed chair. Trump has made no secret he's wanted the Fed to lower rates and they've resisted. So it's fair to assume the new Fed chair will be someone who's in alignment with Trump's initiatives. 50-year mortgages, portable mortgages, the potential for Fannie and Freddie to come out of conservatorship and go public. Fannie and Freddie investing $200 billion in mortgage-backed securities in an effort to lower rates. Okay, so here's the deal. While some of this can influence timing, none of it should ever be the reason why you buy or sell. Buying and selling should always be based on being emotionally, mentally, and financially ready, and keyword, comfortable. The conditions at the time just impact how we get from A to B. If this helped you see the market a little more clearly, do me a favor, send this to someone who's been on the fence. Markets don't reward certainty, they reward clarity and preparation. If you want a grounded, no pressure conversation about what makes sense for you in 2026, please reach out.